March 2017 has come in like a lion for the markets, with stocks, and particularly in the US, breaking out to new all-time highs. Over the course of the month, we should find out if March is going to go out like a lion or go out like a lamb. There's a few key themes that can drive trading over the course of the month. One is technicals. Have markets moved up too far too quickly? Two is political developments in the United States. Three is the upcoming Fed meeting, what that could mean for the US dollar and US interest rates. And finally, overseas developments. The Dow Jones has started off March by breaking out to another all-time high, blasting through the 21,000 round number. It's absolutely incredible to think that on election night, November the 8th, the Dow was at 17,500. It's added over 3,500 points in about 2.5 months. So it has really moved up a lot. It's become overbought technically, but at the same time, it could stay overbought for quite a long period of time, as we've seen in recent weeks. What is significant, though, is that while we're getting a new highs for the Dow and for the S&P, we have not been getting confirmation from the NASDAQ or from the Russell 2000. The NASDAQ is a concern because it's primarily technology and momentum stocks and often leads in rallies. The Russell 2000 not confirming is an issue because it's suggesting that the small caps are no longer following the big caps. The troops may not be following the generals anymore, and if we do get a rally concentrated in a smaller number of larger cap stocks, it could become quite vulnerable. So far, it looks like healthcare reform and tax reform are going to move together hand in hand first. And the congressmen have indicated that they expect and are hoping to get this finalized by the end of August. It is possible that the infrastructure part of spending could get put off to 2018, which could have an impact on trading in the markets. As we start to figure out what's being prioritized, what's going to move first, we could see some sifting within the stock market where some of the sectors that are a higher priority could gain favor over sectors where spending and reforms are going to be delayed. This is also a really, really big month for the Fed. Since the election, the US dollar has been rallying on anticipation that the policies from President Trump could end up being inflationary and could put pressure on the Fed to start raising rates at a more aggressive pace than they have in recent years. In 2015 and 2016, the Fed's rates raised once per year. The current party line from the Fed is that they're looking to raise rates 3 times in 2017. The street, however, has been pricing 4 or 5 increases into the US dollar. March is the month where the rubber hits the road on that as well, because if the Fed wants to do gradual rate hikes through the year, and they're planning to do 4 rate hikes, they need to go in March, followed by June, September, and December. If they don't raise rates in March, then we would be looking at fewer rate hikes. Here in the last few days, the market speculation on a March rate hike has absolutely spiked. Here on March the 1st alone, the Fed funds have gone from pricing in a 50% chance of a rate hike in March to an 84% chance of a hike in March. The reason is because one of the big 3 at the Fed, New York Fed President Dudley, came out and said that it looks as though conditions are aligning for a rate hike in the near future. The market took that as a signal that March is clearly open for a potential rate hike. There's a number of developments between now and the March 15th Fed meeting that could have an impact on whether the Fed raises rates or not. So a few things to watch for. On Friday, March the 3rd, Fed Chair Yellen and Vice Chair Fisher are both speaking. They might give an indication on which way their thinking is heading. On Wednesday, March the 8th, we get ADP payrolls. On Friday, March the 10th, we get non-farm payrolls. And the big decision is 2:00 p.m. Eastern Standard Time on Wednesday, March the 15th. There are a number of other developments both in the United States and overseas that could potentially move the markets over the course of March. March the 15th is looming to be a really, really big day potentially for world markets. Not only is it the Ides of March, not only is there a Fed decision, but on top of that, it's the day that the previously agreed to deal on the U.S. debt ceiling comes off. Once that comes off, you start running into the risk of negotiations over budget, negotiations over the debt ceiling, political uncertainty, the potential for a U.S. government shutdown at some point, and all kinds of things that had political risks that had gone away for quite some time. On top of that, March the 15th is also the day, election day in the Netherlands, where we'll be seeing how are the Eurosceptic parties doing in that country. And it begins the round of big elections this year in Europe, which includes France, Germany, and possibly Italy as well. In addition to that, there's also a G20 finance ministers meeting being held this month, which is the first chance for the U.S. Administration to get out and start talking with a number of their counterparts. And finally, by the end of the month, the UK government is expected to trigger Article 50 and commence the Brexit process. The movement towards that could also influence trading in some markets over the course of the month. So in conclusion, March looks like it has the potential to be a very, very active month for trading, with the potential for big swings in both directions. We could see follow through, we could see corrections. March has come in like a lion. It certainly looks like it could stay like a lion well through the first half of the month, and we'll see what happens towards the end as to whether it finishes strong or finishes weak.